Hi everybody, this is Ellman, the blue collar investor, with today's covered call writing question of the day. Today's question comes from Len of Tan Zhou, China. Alan, sometimes you achieve a double by selling a call at a certain strike, and then if the stock plunges, you buy the option back quickly at a cheaper price. Then you wait for the stock to rebound and then resell the original strike option again. How does one know whether the stock will rebound quickly or not? It seems like this could be guesswork or luck. Well, Len, let's first take a look at the hitting a double strategy as you describe it. What we do first is sell an option based on the BCI methodology. Now, if the stock plunges rapidly, we buy back the option based on our 20%, 10% guideline, which is detailed in my books and DVDs. But a basic review of that is that we'll buy back the option at 20% or less of the original premium in the first half of the contract cycle, and at 10% or less in the second half of the contract cycle. Then we look to resell the option if the price of the stock accelerates. Now, let's take a look at a chart where I actually did hit a double. And in this chart, you can see the classic V-shaped pattern. We sold the option originally at $4.10, where you see the arrow on the left-hand side of the chart. Then, as you can see, the price of the stock declined rapidly early in the contract. At that point, we bought to close the option at 85 cents, which did meet our 20% guideline. Then we waited to see if the price of the stock accelerated again, which in this case it did, and we resold the same option at $3.10. So if you take the $3.10 credit and the 85-cent debit, we have a total credit of $2.25 per share, or $225 per contract, by using the hitting a double strategy. Now, let's get back to your question about whether or not this is guesswork or luck. And let's first discuss when we would use this strategy. Well, the most important point here is that I look to hit a double early in the contract cycle. I'll always buy back the option based on the 20%, 10% guideline. But early in the contract cycle, I have a little more patience for waiting to see if the price of the stock accelerates. I'll base my decision on the chart technicals and my overall market assessment. So if those two things are mixed to positive, I'll definitely wait at least until the beginning of the second half of the cycle to look to hit a double. Now, this is based on sound, fundamental, technical, and common sense principles. Stocks will whipsaw up and down. So, if one were to say to me, well, I think it's luck, then my response would be, well, then luck is the intersection of preparation and opportunity. I hope you agree. Len, do me a favor. Help to spread the word about the blue-collar investor over there in China. I'd really appreciate it. And thanks to you and all of our viewers for watching this video. I hope you found it useful. As always, this is Ellman, the blue-collar investor. Take care, everybody.